Hello and welcome to this video. In this video, we are going to learn about budgeting and budgetary control in detail. Budgets are the financial plans for an upcoming period which states the revenues and expenses. The act of preparing the budget is called as budgeting, and when the business controls and manages the cost based on budget, it is called as budgetary control. As budgets are for the future period, hence it is usually get confused with the forecast. However, there is difference between the forecast and budget. You see, forecast consists of anticipated or the probable events, whereas budgets are planned events. Forecasts are for long-term periods, say 5 years or 10 years, whereas budgets are for short-term period like monthly budgets, quarterly budgets and annual budgets. Forecasts are tentative, whereas budgets are target focused. There are various ways of setting or classifying the budgets, but based on our syllabus, we are going to learn 4 methods of budgeting. The first one is zero-based budgeting, then we have incremental budgeting, then we have fixed budgeting and flexible budgeting. So now let's understand zero-based budget. Zero-based budget is a budgeting technique in which all the expenses must be justified for a new period. That is, in which we start from zero or we do not take the previous budget into consideration. And what we do here is we build up the new budget from the scratch. And then we have incremental budget where we take the previous year's budget and add and subtract to make the changes which reflect our new budget for the upcoming period. Then we have fixed budget. It is also called a static budget, and this is the one in which the objectives and the targets are fixed and remain unchanged irrespective of the level of activities actually attained. Whereas when we talk about the flexible budget, it is a budget that can be adapted to make the changes which are required based on the actual production or actual activity of the business. There are various steps which are involved in making the budget. We start with the management objective. This can be to increase the sales or to increase the production. Based on this, what we have is we will have certain limiting factors or the factors which limits the budget. And based on this limiting factors, we make the sales budget if the limiting factors are related to sales, or we make the production budget first if the limiting factors are related to production. After making the sales and the production budget, we make the purchase budget and the labor budget from the production budget. Then we make the expenditure budget, and from the sales budget we make the trade receivable budget. From the purchase budget we make the trade payable budget. Then taking all the information from various budget we make the cash budget, and lastly we make the master budget, which includes the budgeted statement of profit or loss and the budgeted statement of financial position. Now let us understand the limiting factors. Limiting factors are the circumstances that limits or restricts the activity of the business. This may be limited demand, and when the demand is limited, naturally we can produce and sell based on our demand, or it may be a shortage of labor, shortage of material, shortage of space of production, or shortage of storage capacity, or shortage of cash. And because of all this, we have to limit our production, and as we have to limit our production and sales, our budget will also be limited. So based on what kind of limitation we are facing, if we are facing a limitation in demand, then we make the sales budget first, or if we are facing a limitation in production, then we make the production budget first, and then based on this budget we fit in all the other departmental budgets. Now let's understand the sales budget. This is in some books referred as revenue budget. This is equal to the estimated budgeted volumes of sales unit, and we multiply it with the selling price per unit. That is, we get the sales revenue for this. That is, sales revenue is equals to the unit which is expected to be sold times the selling price. We will have an example here about the chocolate production company, and here the chocolate bar is sold for $8. So our budgeted sale will be the number of chocolates sold, maybe it may be 2, 3, 4 or whatever it is the budgeted amount of chocolates which we are going to sell times $8, that is 2 times 8 will be $16, 3 times 8 will be $24. So based on the budgeted volume of sales, we multiply it with the selling price per unit, we get the budgeted sales revenue. Now let's understand the sales budget with the help of an example. We have an example here where we have H&T Limited produces and sells chocolate bars and wanted to increase its sales by 25%. Sales for the current year 4 quarters are as follows. Quarter 1 64,000 units, quarter 2 76,800 units, quarter 3 96,000 units and quarter 4 83,200 units. The current price per unit is $8 and the company does not expect any change in the price in the upcoming period. We are asked to prepare the sales budget for the upcoming budgeted 4 quarters. Now let's start with the working notes. We will first find the number of units sold during the budgeted quarters. It is given that there will be a 25% increase. That means if we take the first quarter sale to this, if we add 25% again, then we get the sales for the first budgeted quarter. So we'll start with 64,000 times 25%, which will be 16,000 units, and when we add this, that is 64,000 plus 16,000, we get the amount as 80,000 units, and this will be the first quarter sale. Or what we can do is we can take the current sales as 100% to this. If we add 25%, it becomes 125%. Or we can also write this as 125 divided by 100, which can also be written as 1.25. So when we know this, that is 1.25, and we multiply it with the current quarter sales, we get the budgeted quarter sale. Like 64,000 times 1.25, we get the value again as 80,000, which is same as this. So 80,000 times the selling price, which is $8, we get the sales revenue for the first budgeted quarter as $640,000. Then for the second budgeted quarters, we have the current sales as 76,800 units. We multiply it with 1.25, we get the value as 96,000 units. We multiply it with the selling price per unit, which is $8. We get the sales revenue as $768,000. Then for the third quarter, in the same way, here we have the current sales as 96,000 units. We multiply it with 1.25, we get the value as 120,000 units. We multiply it with $8, we get the sales revenue as $960,000. Then for the fourth quarter, we take 83,200 times 1.25, we get the value as 104,000 units. We multiply it with $8, we get the sales revenue as $832,000. Now let's make the sales budget. We'll start with the budgeted quarters. We have quarter 1, quarter 2, quarter 3 and quarter 4 and total. We start with the units, which we have calculated here as for the first budgeted quarter as 80,000, for the second budgeted quarter as 96,000, for the third quarter as 120,000 and for the fourth quarter as 104,000. So we have mentioned the units here, and when we total this up, it will be 400,000 units. We have the selling price of $8, and for each quarter it remains same, so it is $8 for the each quarter. Then we have the sales revenue. For the first quarter, we have calculated it as $640,000. For the second budgeted quarter, it was $768,000. For the third budgeted quarter, it was $960,000. And for the fourth budgeted quarter, it was $832,000. So we have mentioned it here. And when we total this up, it will be $3,200,000. Or if we multiply 400,000 times 8, we get the same value as $3,200,000. Now let's understand about the production budget. In production budget, we estimate the quantity of goods to be produced during the budgeted period. You see, when we talk about the total inventory, it consists of the opening inventory and the units produced, and this makes up our total inventory. From there we sell the goods, and whatever is left after selling of the goods will be our closing inventory. So for this, if we write this in the formula, it will be total inventory available minus sale will be equal to the closing inventory. Or we can write this total inventory as the opening inventory plus production minus sales, which will be equal to the closing inventory. Now we can transpose this formula in different ways to find different values. Like if you want to find the unit produced or the production, then what we will do is we will transpose the sales and the opening inventory to the other side. So it will be sales plus closing inventory minus the opening inventory. Or if you want to find the opening inventory, then what we can do is we can keep the opening inventory here and transpose the production and the sales to the other side. So it will be sales plus closing inventory minus production if you want to find the opening inventory. Now let's understand the production budget with the help of an example. We will proceed with the same example which we have done in the sales budget. We have further information here where H&T Limited decided that the number of units in its inventory at the end of each quarter should be equal to 10% of the next quarter's predicted sales. The finished goods closing inventory at the end of the fourth quarter budgeted period is estimated to be 9,000 units. We are asked to prepare the production budget for the budgeted 4 quarters. Now let's do the working notes. We'll start with the units to be produced for the budgeted period or the budgeted production, which will be equal to the sales budget. From there we get the units sold, so we'll take the sales units here plus the closing inventory minus the opening inventory. We know the closing inventory as it is given here. It will be the 10% of the next quarter's predicted sale. Now what about the opening inventory? The opening inventory will be the last period's closing inventory. For example, if you have got a job last month and your salary is $3,000 and you have spent $2,000 during last month, so you are left with $1,000. This will be the closing balance of your salary which you are left with from the last month, and this will be the opening balance, that is this money you will use in this month. So this will be the opening balance for this month. In the same way, in the business, when we talk about the inventory, if they have a closing inventory for the last period, that will become the opening inventory for this period. So now let's do the calculation for the first budgeted quarter, where we are going to calculate the units to be produced, and the sales based on our sales budget for the first quarter is 80,000 units, plus the closing inventory will be the 10% of next quarter's predicted sale. So for this, the quarter 2 predicted sales are 96,000 units. 10% of this will be 9,600 units. Now we have to find the opening inventory. Again, I'm telling you the opening inventory will be the last quarter's closing inventory. So here the last quarter will be the current year's last quarter, and for that period we will have the closing inventory as 10% of the next quarter's predicted sale. That is, here the budgeted quarter 1 will be the next quarter. So here the predicted sales are 80,000. So 10% of 80,000 will be 8,000. So now we will have 80,000 plus 9,600 minus 8,000, which will be 81,600 as units to be produced. In the second quarter we have sales as 96,000 units based on our sales budget, plus again the closing inventory will be the 10% of next quarter's predicted sale. Here the next quarter's predicted sale is 120,000 units times 10%, it will be 12,000 units. And now the opening inventory will be the closing inventory of the last quarter, which is this, that is 9,600 will be the opening inventory for the second quarter as 9,600. So now we have 96,000 plus 12,000 minus 9,600, which will be equal to 98,400 units. Then for the third quarter, again units to be produced will be equal to the sales unit, which is 120,000 units, plus the closing inventory 10% of the next quarter's predicted sale. So again in the sales budget we have calculated the next quarter's predicted sale as 104,000 units. 10% of this will be 10,400 units, and here again the opening inventory will be the closing inventory of the last quarter, which is 12,000 units. So it will be 120,000 plus 10,400 minus 12,000, which will be equal to 118,400 units. Then in the fourth quarter, units to be produced, the sales are again 104,000 units from the sales budget, plus here the closing inventory is given as 9,000 units. So we are going to take that the opening inventory will be again the closing inventory of the last quarter, that is 10,400 units. So we will get unit to be produced in the fourth quarter as 102,600 units. Now let's make the production budget. We will have the budgeted quarter 1, quarter 2, quarter 3 and quarter 4. We start with the opening inventory. For the first quarter, we have calculated the opening inventory as 8,000 units. So we write 8,000 here. To this we add the units to be produced, that is our production, and for the first quarter it is 81,600. Then we get the total of 89,600. From here we subtract the units sold, which we get from the sales budget, and the units sold were 80,000 for the first budgeted quarter. Now we get the closing inventory as 9,600 units. This is the closing inventory for the first quarter, and it will be the opening inventory for the second quarter. So we will start with 9,600 for in the second quarter, and then we add units to be produced or the budgeted production of 98,400 units. Then we get the total as 108,000. From there we subtract sales of 96,000. We get the closing inventory as 12,000. This closing inventory will be again the opening inventory for the next quarter. So in the third quarter we start with 12,000. We add units to be produced or the budgeted production of third quarter is 118,400. So when we total this up, it will be 130,400. From there we subtract 120,000, which are our sales for the third quarter. We get the closing inventory as 10,400 units, and this will be the opening inventory for the fourth quarter, and we start with 10,400 here. To this we add units to be produced or the budgeted production, which is 102,600 units. We get the total as 113,000. From there we subtract the sales of 104,000. We get the closing inventory as 9,000 units. Now let's understand about the purchase budget. After doing the calculation of units to be produced in the production budget, we need to buy the raw material to produce them, and this is done in the purchase budget. Purchase budget can be made for both kind of businesses, that is manufacturing businesses as well as the retailing businesses. In manufacturing business, we calculate the raw material purchase for the production, and this is done on the basis of the production budget, whereas for retail businesses, we make the purchase budget for the goods to be purchased, and this is prepared from the sales budget. In the purchase budget, we do the following calculation. We start with the units to be produced per the production budget. To this, we add the closing inventory, we subtract the opening inventory, and then we multiply this with the quantity of direct material per unit produced, and we multiply it with the price per unit of direct material. And now we'll understand this with the help of the example, where we will continue with the same example for a H&T Limited. Each unit of chocolate require 1.5 pound of direct material per unit, and the cost of direct material is $2 per pound. And the management prefer to maintain end raw material inventory equal to 30% of the next quarter's material needed in production. Assuming the raw material inventory at the end of the fourth budgeted quarter is estimated to be 41,000 pounds, we are asked to prepare the purchase budget for the budgeted 4 quarters. Let's start with the purchase budget. We start from the units to be produced from the production budget. For the first quarter, it is 81,600 units, and the material required per unit is 1.5 pound. So what we will do? We will multiply this, that is 81,600 times 1.5 will be equal to 122,400 pounds of material needed for production in the first quarter. In the same way, if we go for the second quarter, we have 98,400 units multiplied with 1.5, we get 147,600. For the third quarter, we have 118,400 times 1.5, which will be 177,600. And again in the fourth quarter, from the production budget, units to be produced was 102,600 times 1.5, it will be 153,900 pounds of material needed for the production. Now to the material needed for production, we add the closing inventory. It was given that the management policy to maintain the closing inventory is that it will maintain 30% of the next quarter's material needed for production. So for the first quarter, we'll take the second quarter's material needed for production, which is 147,600 pounds, and we find 30% of this, which will be 44,280 pounds. Then for the second quarter, we'll take the third quarter's material needed for production, which is 177,600 pounds times 30%, which will be 53,280 pounds. For the third quarter, we'll take the fourth quarter's material needed for production, which is 153,900 pounds times 30%, which will be 46,170 pounds. And for the fourth quarter, it was given that the material needed for production was 41,000 pounds. When we add this to, that is 122,400 plus 44,280, we will get 166,680. And for the second quarter, it is 147,600 plus 53,280, which will be 208.80. For the third quarter, it will be 177,600 plus 46,170 will be 223,770. And for the fourth quarter, it is 153,900 plus 41,000, which will be 194,900 pounds. Now we'll subtract the opening inventory. You see, the opening inventory will be the closing inventory of the last quarter. So for the first budgeted quarter, what we will do is we'll take the closing inventory of the last quarter of our current year, and that will be 30% of the material needed in the first quarter, which is 122,400 times 30%, will get 36,720. Now for the budgeted second quarter, this will be the closing inventory of the last quarter, that is budgeted first quarter. This will be the closing inventory, and this will be the opening inventory for the second quarter as 44,280. In the same way, for the third quarter, this closing inventory of the second budgeted quarter, which is 53,280, will be the opening inventory for the third quarter. In the same way, for the fourth quarter, the closing inventory of our third quarter, which is 46,170, will be the opening inventory for the fourth quarter. Now, as we know all the opening inventories, we are going to take this and subtract it. For the first quarter, it will be 166,680 minus 36,720. We get the total material purchase as 129,960. Then we have 200,880 minus 44,280. We get the value as 156,600 as total material purchase for the second quarter. In the third quarter, we have 223,770 minus 53,280. We get the total material purchased as 170,490. In the fourth quarter, we have 194,900. From there, we subtract 46,170. We get the total material purchase as 148,730. Now we know this is the total material purchase in terms of weight, that is in terms of pounds. Now we have to calculate in terms of value, that is we will multiply it with the cost of material per pound is $2, and then we multiply this with $2, that is 129,960 times 2. We get the cost of material purchase as 259,920 for the first quarter. In the same way, for the second quarter, it is 156,600 times 2, which will be 313,200. In the third quarter, it will be 170,490 times 2, which will be 340,980. And in the last quarter, that is the fourth budgeted quarter, we have the total material purchase as 148,730 times 2, which will be equal to $297,460. Now let's understand about the labor budget. In the labor budget, we will calculate the wages which have to be paid to the workers to produce the units which we have already calculated in the production budget. For this we have the formula, that is unit produced as per the production budget. We multiply this with the labor hours required per unit of product, then we multiply it with the wage rate per labor hour. So we'll proceed again with our same example, that is H&T Limited requires 0.20 direct labor hours at the cost of $12 per hour for each unit of product to be produced, and now we are required to make the labor budget for the 4 budgeted quarters. Now let's make the labor budget. We'll take the number of units to be produced from the production budget, where for the first quarter we have 81,600, for the second quarter we have 98,400, for the third quarter we have 118,400, and for the quarter 4 we have 102,600. Now we got the production budget's number of units produced. Now we will multiply it with the labor hour required per unit, which is 0.20. So 81,600 multiply it with 0.20, we get the total labor hours required in production for first quarter as 16,320. In the same way, 98,400 times 0.20, we get the value as 19,680. In the third quarter, it is 118,400 times 0.20, we get 23,680. In the fourth quarter, it is 102,600 times 0.2, we get the value as 20,520. Now next we have to multiply this with the wage rate per labor hour, which is 12 here. So for the first quarter it will be 16,320 times $12, which will be $195,840 as total direct labor cost for the first quarter. In the second quarter we have 19,680 times $12, which will be 236,160. In the third quarter we have 23,680 times 12, which will be 284,160. And in the fourth quarter we have 20,520 times 12, which will be $246,240 as total labor costs. So this is how we make the labor budget. Now let us understand the trade receivable budget. Trade receivable budget deals with calculation of the amount of cash to be received from the credit customers. As we are dealing with the credit customers here, hence cash sales will not be a part of the trade receivable budget. Furthermore, we will proceed with the same example which we are dealing, that is based on the sales budget of H&T Limited. 70% of sales are on cash and 30% are on the credit. That is this credit sales. For this we will collect the cash from the debtors in the following quarter. Furthermore, the closing balance of trade receivable from the current year's last quarter is $200,000. We are asked to prepare the trade receivable budget for the budgeted quarters. Now let's do our calculation in the working notes. So we have to start it from the sales budget, and from the sales budget, now as we have to find the cash and the credit sales, we take the sales revenue. So for quarter 1, the sales revenue which we have from the sales budget is $640,000. 70% of this will be $448,000, and this will be taken in the cash budget. For now we need to know the credit sales, and 30% of 640,000 is the credit sale, which will be equal to $192,000 for the first quarter, and this will be used in our trade receivable budget. In the second quarter we have the sales revenue as $768,000. 70% of this will be $537,600, which will be our cash sales, and for trade receivable we need to find the credit sales, which is 30% of this, and we'll get the value as $230,400. Then in the third quarter we have the sales revenue as $960,000, and 70% of this will be $672,000, which will be taken again in the cash budget, and the credit sales will be 30% of $960,000, which will be $288,000, and this will be used in our trade receivable budget. And in the fourth quarter we have the sales revenue as $832,000. 70% of this will be $582,400, and the credit sales which we require for the trade receivable budget will be 30% of $832,000, which will be $249,600. Now let's make the trade receivable budget. We will start with the opening trade receivable. It is given here the closing balance of the trade receivable for the current year's last quarter is $200,000. This will be the opening balance for the first budgeted quarter. So we have mentioned $200,000 here. Then we add the credit sales for the quarter, which we have calculated here as $192,000. So when we total this up, we get $392,000. Then we subtract the cash received. It is mentioned here the credit sales are collected in the following quarter. So the last quarter's current year's sale will be collected in the first budgeted quarter, that is $200,000 will be the cash received, and when we subtract this, we get the closing trade receivable as $192,000. This is the closing trade receivable, and this will be the opening trade receivable for the second quarter, and to this we add the credit sale, which is $230,400. We get the total as $422,400. Then the cash received, which are the previous quarter's credit sale, that is $192,000, will be subtracted. We get the closing trade receivable as $230,400 for the second quarter, and this will be the opening trade receivable for the third quarter. Then to this we add the credit sales for this quarter, which is $288,000. We get the total as $518,400. From there we subtract the cash received, which are the credit sales for the second quarter, which is $230,400. We get the total as $288,000 as the closing trade receivable for the third quarter. This will be the opening trade receivable for the fourth quarter. To this we add the credit sales for the fourth quarter, which is $249,600. We get the total as $537,600. From there we subtract the cash received, which is $288,000. We get the closing trade receivable as $249,600 for the fourth quarter. So this is how we make the trade receivable budget. Now let us understand the trade payable budget. In trade payable budget, we calculate the amount of cash to be paid to the credit suppliers for a given period. Again, we are talking about the credit suppliers, hence cash purchases will not be a part of the trade payable budget. We will proceed with the same example where we have, based on the purchase budget of H&T Limited, 80% purchases are on cash and 20% purchases are on credit paid in the following quarter. Furthermore, the closing balance of trade payable for the current year's last quarter was $50,000. We are asked to make the trade payable budget for the budgeted quarters. So we'll start with the working notes, where we will take the total cost of material purchase from the purchase budget. For the first quarter, it is $259,920, and 80% of this will be the cash purchases, which is $207,936, which we are going to use in the cash budget. But for now, we have to find the credit purchases for the trade payable budget, which is $259,920 times 20%, which will be $51,984. For the second quarter, the total amount of raw material purchase based on the purchase budget was $313,200. 80% of this will be the cash purchases, which will be $250,560. And for the trade payable budget, we need the credit purchases, which will be 20%, and the value will be $62,640. Then for the third quarter, the total value of material purchased from the purchase budget is $340,980. 80% of this will be $272,784, and the credit purchases which we require for the trade payable budget will be 20% of this, which will be $68,196. And then for the fourth quarter, again we have $297,460 from the purchase budget. 80% of this will be the cash purchases, which will be $237,968. This will be for the cash budget. For now we need the credit purchases for the trade payable budget, which will be 20% of this, and it will be $59,492. Now let's make the trade payable budget. We'll start with the opening trade payable balance, which will be the closing balance of the last quarter, which is 50,000 given here. So this will be the opening balance for this quarter one. Then we'll add the credit purchases, which we have calculated as $51,984. So when we add this, we get a total of $101,984. Then we subtract the cash paid. Here it is mentioned that we are going to pay the creditors in the following quarter. So this 50,000 will be paid in the first quarter. So we subtract this 50,000, we get the closing trade balance as $51,984. So this is the closing balance for the first quarter. This will be the opening balance for the second quarter. So we will start with 51,984. To this we add the credit purchases for this quarter, which is 62,640. So when we add this, we get the total as 114,624. From here we subtract the credit purchases because we are going to pay this from the first quarter. So we have paid this as cash paid. $51,984 will be subtracted. So we'll get the closing trade payable balance as $62,640. Again, this will be the opening balance for the next quarter. To this we add the credit purchases of the third quarter, which is $68,196. So the total will be $130,836. From there again we subtract the credit purchases of the second quarter because we are going to pay it in the third quarter. So it will be minus $62,640. We will have the closing trade payable balance as $68,196. This is the closing balance, and this will be the opening balance for the next quarter, which will be $68,196. To this we add the credit purchases of the last quarter, which we have here as $59,492. So when we add this, we get the total as $127,688. From there again we subtract the cash paid for the credit purchases of the third quarter will be paid in the fourth quarter. So it will be $68,196 will be subtracted. So now the closing trade payable balance for the fourth quarter will be $59,492. So this is how we make the trade payable budget. Next we have the expenditure budget. In expenditure budget we write all the expenditures, that is the payment to the purchases plus all the other expenditures, and this is an optional budget. We can directly make the cash budget, and based on our syllabus we don't have expenditure budget, so we'll directly make the cash budget. But just for an idea, you need to know that there are various type of expenditure budget which we make, that is the budget for the selling and distribution expenses, then the capital expenditure budget, the manufacturing expenditure budget, and other budgets can be made. But again, this is an optional budget and we will start from the cash budget. However, many companies make expenditure budget because this makes the making of or formulating the cash budget in a easier way, and hence this is usually made so that making the cash budget becomes easier. Now let's understand the cash budget. Cash budget is just like the business bank account. In this we will calculate all the money which will be received and paid during a given period, and as we are dealing with the cash budget, here all the transactions should be on cash basis. Non-cash items like depreciation or discounts will not be included here. For cash budget, we take the information from the various other budgets, that is the sales budget, the trade receivable budget, the trade payable budget, and the other expenditure budget. We have to take the following thing into consideration when we make the cash budget, that is revenue will be allotted to the month in which it is received. We will take the money which we receive from the credit customers as well as the cash sales, and for credit customers we will allot it only during the period when we receive it, after deducting the discount, and discount allowed will not be shown as a separate expense in the cash budget. Furthermore, the payments to supply must be shown in the month in which they are paid, and the discount received from the supplier will not be shown as a separate income. The reason is here there is no exchange of money, hence we are not going to show the discount allowed or discount received in our cash budget. Now let us proceed for the cash budget with the same example, which is H&T Limited incurred additional manufacturing variable expenses of 70 cents per unit and manufacturing fixed overhead per budgeted quarter are salaries 28,000, rent 22,000 and depreciation $16,165. Also selling and administrative expenses for each budgeted quarter are salaries 60,000, rent 7,000, advertising 10,000, depreciation 8,000 and others as 1,000 per budgeted quarter. Additionally, the company plans to purchase selling and administrative equipment totaling $20,000 and production equipment totaling $28,000. Both will be purchased at the end of the fourth quarter and will not affect depreciation expense for the coming year. Furthermore, the closing cash balance of current year's fourth quarter is $20,000. We are asked to prepare cash budget for the budgeted quarters. Now we'll start with the calculation in our working notes. We'll start with this, that is additional manufacturing variable expenses is 70 cents per unit. So we will pay this on the number of units we have produced, which we will take from the production budget. So for the first quarter, the units produced from the production budget is 81,600 units. We multiply it with 70 cents, we get the value as $57,120. In the second quarter, the units produced from the production budget is 98,400 units. When we multiply this with 70 cents, we get the value as $68,880. In the third quarter, the units produced are 118,400 units. We multiply it with 70 cents, we get the value as 82,800 units. Then in the quarter 4, we have the units produced as 102,600 units. We multiply it with the 70 cents, we get the value as $71,820. Furthermore, it is given here that we are purchasing two equipments, that is one for the selling and administrative equipment and one is the production equipment. So we are purchasing two equipment, so our capital expenditure will be $20,000 plus $28,000, which will be $48,000. In the cash budget, we find the net receipts or the net payments, and we get this by taking the total receipts. These are the total cash inflows. Here we have cash sales and cash received from the trade receivable. We can also have cash received because of the issue of shares, or cash received because of more borrowing or loan, or cash received because of the disposal of any non-current assets. So whatever leads to inflow of cash will be the cash receipts, and we total them up and this will be the total receipts, and from there we subtract all the payments. So here we have the payments as total purchases, which will be subtracted. Then we have the total of other manufacturing expenses, which will be subtracted. Then we have the total of selling and administrative expenses, which will be subtracted, and then we have the capital expenditure, and this is also an outflow of cash, hence this will be subtracted. So once we do this, we find that if the value we get is positive, that means the total receipts are more than all the other total payments. Hence we have the net receipts. If the total payments are more than the total receipts, we get the negative value. In the cash budget, we'll start with the receipts, and two cash receipts or cash inflows which H&T Limited have is cash sales, and this have been calculated before the trade receivable budget in our working notes. So I'll mention that here, which is $448,000 for the first quarter, $537,600 for the second quarter, $672,000 for the third quarter, and $582,400 for the fourth quarter. Then we will write the cash received from the trade receivables, which we have calculated in the trade receivable budget, and for the first quarter it was $200,000, for the second quarter it is $192,000, for the third quarter it is $230,400, for the fourth quarter it is $288,000. Then what we do, we add both of this, that is the cash sales and total cash received from the trade receivable, to get the total receipts. So we add 448,000 plus 200,000, which will be $648,000 for the first quarter. Then for the second quarter, again we add this too. So we get the total receipts as $729,600. For the third quarter, we get the total receipts as $902,400. And for the fourth quarter, we get the total as $870,400. Now we will calculate the payments. We will start with the cash purchases, which we have calculated in the working notes before the trade payable budget. And for the first quarter, it was $207,936. For the second quarter, it is $250,560. For the third quarter, it is $272,784. And for the fourth quarter, it is $237,968. Then the trade payable which we have paid, this is the amount paid to the trade payable from the trade payable budget. For the first quarter, it was $50,000. For the second quarter, it is $51,984. For the third quarter, it is $62,640. And for the fourth quarter, it is $68,196. Now we total the cash purchases and trade payables to get the total purchases. That is $207,936 plus $50,000. We get the total purchases for the first quarter as $257,936, and as this is a payment, hence it will be negative. That is, it shows the outflow of cash. Then in the same way, we add the cash purchases and trade payables for the second quarter as well, and we get the total purchases as $302,544. And for the third quarter, we get the total purchases as $355,424. And for the fourth quarter, when we add cash purchases and trade payables, we get the total purchases as $306,164. Next, we have other manufacturing expenses. We start with the direct labor, and this was calculated in the labor budget. For the first quarter, it is $195,840. For the second quarter, it is $236,160. For the third quarter, it is $284,160. And for the fourth quarter, it is $246,240. Then we have the manufacturing variable expenses, which we have calculated in the working notes for the cash budget. For the first quarter, it is $57,120. For the second quarter, it is $68,880. For the third quarter, it is $82,880. And for the fourth quarter, it is $71,820. Then we have manufacturing fixed expenses. Salary is $28,000 per quarter. That is for the first, second, third and fourth quarter, it is $28,000, $28,000 and $28,000. Then the rent again is $22,000 for each quarter. So for the first, second, third, fourth quarter, it is $22,000, $22,000, $22,000 and $22,000. Then we total this up. So we get the total, that is, we take $195,840 plus $57,120 plus $28,000 plus $22,000. We get the total as $302,960. In the same way, when we total up for the second quarter, it will be $355,040. For the third quarter, when we total this up, we get the value as $417,040. And when we total this up for the fourth quarter, we get the value as $368,060. Next, we have selling and administrative expenses, in which we have again salaries, and salaries is same for all the quarters. That is, for the first quarter it is $60,000, for second quarter, third quarter and fourth quarter it is $60,000. Then we have rent. Again, rent is $7,000 for each quarter, for the first, second, third and the fourth quarter. Then the advertisement expenses is $10,000 each quarter. So for each quarter we'll write 10,000, and then other expenses is 1,000 for each quarter. So for the first quarter it's 1,000, second quarter is 1,000, third quarter it is 1,000 and the fourth quarter it is 1,000. Again, depreciation we are not going to take because it do not lead to any inflow or outflow of cash, hence depreciation is not taken. So now when we total up for the first quarter, it is 60,000 plus 7,000 plus 10,000 plus 1,000, which will be 78,000. In the same way, because we have the same selling and administrative expenses for each quarter, so the total will be same for all the 4 quarters. So 78,000 for the second quarter, and again 78,000 for the third quarter, and 78,000 for the fourth quarter. We have capital expenditure which is only for the fourth quarter, and we have calculated this in our working notes as $48,000, and all these expenses should be subtracted from the total receipts so that we can get the net receipts or net payments. Now we'll find the net receipts or the net payments for the first quarter. We start with the total receipts, which we have here as $648,000. From there we subtract all the other payments, that is we have the total purchases which is $257,936, which is an outflow, so we subtract this. Then we subtract the total other manufacturing expenses, which is $302,960. Then we subtract the selling and administrative expenses total, which is $78,000. We get the value as $9,104, and this is the net receipt which we have mentioned here. Then to this we add the opening bank balance, which was given as $20,000. We get the closing or the ending bank balance as $29,104. This is a closing bank balance for the first quarter, and this will be the opening bank balance for the second quarter. Then again for the second quarter we start with the total receipts, which is $729,600. From there we subtract the total purchases, which is $302,544. Then we subtract the total other manufacturing expenses, which is $355,040. We subtract the total administrative and selling expenses, which is $78,000. We get a negative value of $5,984. So as this is negative, these are the net payments, and we have mentioned it here. And we have the opening balance of $29,104. From there we subtract this $5,984. We get the closing or the ending bank balance as $23,120. This will be again the opening bank balance for the third quarter. Now for the third quarter, to calculate the net receipts, we start with the total receipts of $902,400. From there we subtract the total purchases, which is $335,424. We subtract the total other manufacturing expenses, which is $417,040. We subtract the total administrative expenses of $78,000. So when we do this, we get the net receipts for the third quarter as $71,936. To this we add the opening bank balance of $23,120. We get the closing or the ending bank balance as $95,056. Then this will be the opening bank balance for the fourth quarter. In the fourth quarter, in the same way, we take the total receipts of $870,400. From there we subtract the total purchases of $306,164. We subtract the manufacturing expenses of $368,060. We subtract the total selling and administrative expenses of $78,000. We subtract the capital expenditure of $48,000. We get the net receipts as $70,176. Then we add the opening bank balance of $95,056. We get the closing or the ending bank balance as $165,232. So this is how we make the cash budget. Now let's understand about the master budget. Master budget consists of the budgeted statement of profit or loss as well as the budgeted statement of financial position, which is prepared from the information provided by all the other budgets. The purpose of master budget is to show the management whether we make profit or loss if the expected plan is implemented. And this is a budget which is prepared lastly because we make the master budget from the information which is provided by all the other budgets. So now we'll continue with our example of H&T Limited, and we'll take the information from all the other budgets and make the budgeted statement of profit or loss. The statement of profit or loss starts with the sales revenue, and this information will get from the sales budget, where we have already calculated this, that is 400,000 units are sold and the selling price was $8, and we got the total sales revenue as $3,200,000. We will start with the unit cost so that we can find the total cost. Direct material unit cost, which was calculated when we made the purchase budget, was $3. Direct labor unit cost, which was calculated during the labor budget, was $2.40. Additional manufacturing variable expenses, which was given before the cash budget, was 70 cents. Now we will calculate the additional manufacturing fixed expenses. Salaries per quarter was given as $28,000. We multiply it with 4 to get the value for the year, and it will be $112,000. Rent for one quarter is $22,000, and for the year we multiply it with 4, we get $88,000. Depreciation for one quarter is $16,165. So when we multiply it with 4, we get $64,660. When we add this all together, we get the total additional manufacturing fixed expense as $264,660. This is for the total production. And from the production budget, if we see the total units produced, in the first quarter it was 81,600 units, in the second quarter it was 98,400 units, in the third quarter it was 118,400 units, and in the fourth quarter it was 102,600 units. So when we add all this up, the total units produced during the period was 401,000 units, and this, that is the additional manufacturing fixed cost, is for 401,000 units. For one unit, how much? So what we'll do is we take 264,660 divided by 401,000, we get the value as 66 cents. Now we add all this, that is $3 plus $2.4 plus 70 cents plus 66 cents. We get the cost per unit as $6.76. So this is for one unit, and we want to find the total cost of sales. So how many units we have sold? 400,000 units have been sold, and we can also get this from the production budget. The opening balance was 8,000 units. We have produced during the year as 401,000 units, and the closing balance is 9,000 units. So the units sold was 400,000 units, and when we multiply it with the cost per unit, which is $6.76, we get the total cost of sales as $2,704,000. Now let's make the budgeted statement of profit or loss for H&T Limited. We start with the sales revenue, and this was calculated in the sales budget as $3,200,000. From there we subtract the cost of goods sold, which was calculated in the working notes as $2,704,000. We get the gross profit as $496,000. From there we subtract the selling and administrative expenses. We start with the salaries, and for each quarter the salary was $60,000, and for the whole year, that is 4 quarters, it will be 60,000 times 4, which will be $240,000. Then rent for each quarter, it is $7,000. So for the year it will be 7,000 times 4, which will be $28,000. And then advertising, it was 10,000 for each quarter. So for the year it will be 10,000 times 4, which will be $40,000. Other expenses was $1,000, and for the year it will be 1,000 times 4, which will be $4,000. Then depreciation, it was $8,000 for one quarter, and for the year it will be 8,000 times 4, which will be $32,000. So when we add all the selling and administrative expenses, we get the total as $344,000. So when we subtract this from the gross profit of $496,000, we get the profit for the year as $152,000. We have additional information which states that the following accounting balances are expected at the end of the budgeted year. Property, plant and equipment, net book value, that means cost minus depreciation, we get the net book value, and here the value is $320,000. Ordinary share capital is $610,000. Retained earning at the end of the current year is $56,180. No cash dividend are anticipated for the budgeted period ending 31st December. So now let's start with the working notes. We'll start with the closing inventory. For the finished goods, it was mentioned that 9,000 units will be the closing inventory. From the production budget, we get this information, and we have calculated the cost per unit or the unit cost in our working notes before the budgeted statement of profit or loss, and this was $6.76. So 9,000 times $6.76, we get the value as $60,840. Then for the raw material, in the purchase budget, it was mentioned that the closing raw material which we calculated was 41,000 pounds, and each pound have a value of $2. So 41,000 times 2, it will be $82,000, and this was again taken from the purchase budget. Then we will calculate the retained earning. Here the opening balance of retained earning, which will be the closing balance of the current year, is given as $56,180. Then the budgeted profit for the year, which we have calculated in the budgeted statement of profit or loss, was $152,000. So when we add this up, we get the retained earning for the budgeted period as $208,180. Now let us make the budgeted statement of financial position for H&T Limited. We start with the non-current assets, in which we have property, plant and equipment, and we have been given the net book value of this as $320,000. Then we have the current assets, in which we have the trade receivables. The closing balance of trade receivable budget will be taken, and the value which we got there at the end of the fourth quarter was $249,600. Then we'll take the closing inventories, in which we have the finished goods, which we have calculated in our working notes as $60,840. Then we'll take the raw material closing inventory, which we have calculated again in the working notes as $82,000. Then we take the bank balance, this is the closing bank balance, which we have calculated in our cash budget. This will be the balance at the end of the fourth quarter, which is $165,232. So when we add all the current assets, we get the total as $557,672. And when we add the non-current and the current asset, we get the total as $877,672. Then we have the equity and liabilities, in which we have the share capital and reserves, and we have the ordinary share capital, which was given as $610,000. Retained earning, which was calculated in our working notes as $208,180. So when we add this up, we get $818,180. Then we have the trade payable. This is the closing balance of the trade payable, which we have taken from the trade payable budget the last quarter, which is the fourth quarter. Closing balance was $59,492. So when we add this two, we get the total equity and liability as $877,672. We have two other types of budget, which is top-down budget and the bottom-up budget. In the top-down budget, the management will formulate the aim for the budgeting period, and this will be communicated to the budget committee, and the budget committee will make the budgets for different functional departments. Like for logistic department, they make the purchase budget. For the production department, they make the production budget, and for the sales department, they make the sales and other related budgets. And for human resource department, they make the labor budget, and the finance department, they make the cash budget and the master budget, and thus this will be forwarded to all the functional departments. As we started from the management and ends at different functional departments, it is called as top-down budget. In the bottom-up budget, what happens is each functional department will make their own budgets by communicating with the staff as well as by communicating with the other functional departments. Like for the logistic department, they make the purchase budget, the production department will make the production budget, the sales department will make the sales and any other related budgets, and human resource department will make the labor budget, financial department will make the cash budget and the master budget, and this will be passed to the budget committee, and budget committee will then give it to the management, and this type of budget is called as bottom-up budget. Now let's understand the advantages of budgetary control system. In budgetary control system, what we do is we control the business by means of making budgets. So there are various advantages when we do this. The first one is it helps the management to perform its tasks. The main duties or tasks of management is planning, organizing, coordinating, communicating and controlling, and all these tasks can be performed more effectively and efficiently by means of budgetary control system. Then it encourages managers to think about the future. That's the reason it helps them in planning, and when they plan, it helps them to frame the objectives, and it also helps in optimizing the use of resources. Furthermore, making the budget ensures coordination between various functional departments and staff, as they have to coordinate with each other to fulfill the budgeted target. Hence, it leads to teamwork, and it also leads to both horizontal and vertical communication. If we see top down budget, there will be a vertical communication. When there is bottom up type of budget, then it leads to horizontal communication between different functional departments. So this helps them to have a better communication, two-way communication in the organization. Then it also increases the productivity, efficiency, eliminates the waste and control the cost. And this acts as a controlling mechanism so that it can be used to compare between the actual results and the planned results. And if there is any discrepancy or if there is any variance, then what we can do is we can find the exact or pinpoint the exact changes which are required, so that the needed action can be taken and we can achieve the target easily with more motivation and with more efficiency. There are various disadvantages of the budgetary control system. Like if we have only fixed budget, then it brings very rigidity to the organization, as the actual production may differ from what has been budgeted. So this may lead to rigidity, and it is a time consuming and expensive process, and this may not be suitable for small organization. Furthermore, often budgets are made some months before the end of the current year for the upcoming year. So what happens is, as we start too early, then there are chances that the budget may get outdated very quickly. Furthermore, when the managers are paid performance related pay, then they try to add extra cost to the budgeted cost, or they try to reduce the budgeted revenue so that the targets can be easily met and they may get additional bonus. So this is called as budgetary sack, and this is also one of the drawback of the budgetary control system. And furthermore, this may also lead to conflict among the managers, because each manager will try to take the credit of achieving the budget, and making the budget does not ensure that it will be properly implemented. If it is not properly implemented, then it leads to low morale, and hence this will also be a drawback of the budgetary control system. In the present world, where everything is computerized and all the work is done by means of computers, making of budget is also made computerized by means of spreadsheet and other different computer packages. Now let's understand about the spreadsheet. Spreadsheet is a computer package which stores the data in a matrix format. I have given an example here. So this is the matrix format in which we store all the information in our Microsoft Excel, and this is called as a spreadsheet. And each of this, that is where the rows and column intersect, each of this square box is called as the cell, and this is commonly used for the budgeting process. There are various advantages of spreadsheet. Here we can store large volume of data, and it is very flexible because we can make the changes according to our specific needs. Furthermore, here we can immediately, if you have done work on Microsoft Excel, you will know that we can easily find the formulas, and the calculations are done very easily and in a very fast way, and then this can be easily shared and the collaboration can be done easily by the team. Why? Because now MS Office is on cloud, and the members can access this data from any part of the world, and they can change the data based on the requirement from any part of the world. So this can lead to more easy access as well as convenient for the team members to work together. Furthermore, when we use the computer application for our budgeting control system, then what happens is we cannot just present our data in numerical form, but we can also represent it in a graphical form, like we can make the bar charts and pie charts for different departments budget, and this may have a much better visual effect and this will be more motivating. There are various disadvantages of using spreadsheet. Spreadsheet for a particular budgeted application will be time consuming to develop and it will be costly to develop and maintain. The errors in design may also occur because of the use of formulas. If the formula go wrong, then we get the invalid output, and this is a complex model, hence to locate the errors it will be difficult. Furthermore, there may be some security issues, maybe because of hacking or loss of data because of theft. Then the version keeps on changing, like for MS Office we have MS Office 2020, MS Office 2021, we have MS Office 365 now. So this also leads to issues. Then we have to educate the staff, and as the version keeps changing, hence they have to be updated with the training, and this may be time consuming and costly. Furthermore, spreadsheets are prone to errors and inconsistency as it depends on manual data input. Thanks for watching my videos and have a blessed and peaceful life.